All right, we're going to talk about making sense of market crashes. Now I'm going to look at some market crashes from the last few decades, starting in the early 1970s. And the reason why I focus on 1970s is because there's some significant changes that took place in that time frame. So here along this axis, I'm going to plot some significant crashes or market crises. I'll start with 1973-74, the US bear market. Then look at 1987, it's the global synchronized crash. Then move to the 1990s, where you have the Japanese asset bubble, followed by the Asian financial crisis. Then in 1998, you have the Russian financial crisis. And then 2000, you have the dot-com crisis. 2004, the US housing market crisis, which is a lot more than just the US crisis. 2007 to 2009, you have a bear market that started in the US. And then 2010, you've got the Greek debt crisis, which has now given way to the European Union sovereign debt crisis. So when we look at all these various crises that have occurred over the last 3 decades or so, conventional wisdom will tell us that there's a fixed way to address these. So we either will adjust monetary or fiscal policy, we'll increase the supply of money, we'll perhaps lower tax rates, lower interest rates, embark on some kind of fiscal projects. And that's all well and good, but I think that to make sense of what's really happening, we need a framework that tells us the context behind all this and what kind of patterns are emerging over time. And so I'm going to draw another axis here, and on this axis, I'm going to plot a pattern of sustainable growth. And I've talked about this in some other talks and also written about it in a couple of books. But there is a pattern of sustainable progress. It's a universal pattern that is very well represented in the growth that a seed has in its journey to a flower. So I'm going to represent this and just talk about this very briefly. We have a seed, and then it goes through growth, and then it culminates in the reality of a flower. Now when we look at this, analyze this pattern of sustainable progress, there are 3 distinct phases here. So phase 1 is what I'd call the physical phase. And this phase is, if we think about the seed, it's an inert entity that has very little change to it. And there's this impulse to keep things as they always have been. So there's an impulse to minimize change. So that can be thought of as a first level. We have a second level that I'll refer to as a vital level, and that's a period of growth, often irrational growth, a lot of assertive growth, a lot of experimentation. And as in this journey of the seed to the flower, we see, for instance, there's a tendril structure, a root structure, there's a lot more interchange with the environment. The actual growth may or may not result in the flower, but that's what the possibility is. And then there's a third stage that I'll refer to as the mental level, and that's where the meaning that's implicit in the seed has the high probability of emerging. And here this is characterized by purpose, by comprehensiveness, by intent, and this is a pattern of sustainable progress. And the hypothesis is that any organization has this urge implicit in it to self-organize so that this notion of sustainability becomes real. So whether we're looking at a corporation or a market, in this case we're looking at a market is an instance of a more complex organization that has the implicit urge to self-organize to become more and more sustainable. And this pattern of sustainability is captured in this growth from the seed to the flower. So I'm going to indicate these 3 primary levels by these 3 lines here, and then analyze or briefly look at the nature of these market crises and crashes that we've seen over the last few decades in the context of this pattern of sustainability that is quite universal. So if we look at the 1973-74 US bear market, it's very significant because prior to this, we had for several decades been moving along at a relatively inert level where things were very stable. And what happened in 1971 is that, first of all, the gold standard was abandoned and the US currency as a peg for other currencies was also removed. As a result of this, there was this implicit urge to move from the physical to the vital, a very strong urge. And what we see is that this decades-long movement that perhaps comes here now gets an acceleration to move upward toward the vital level. And let's look at this in a little more detail. What happens here is that since the gold standard is abandoned and since the US dollar is no more a peg for other currencies can diverge. They begin to float, and the criteria that they have used to maintain their value now begins to diverge. So we see a lot more change in the relative exchange rates. We see a lot more loosening of the money supply in the world, and we see a notion of the change of wealth. So the whole notion of wealth and of value begin to change and diverge. The money supply begins to increase rapidly. Inflation begins to increase rapidly as a result. And in this uncertainty, there's one more thing that happens, is that the OPEC, in effect, announces an oil embargo, which shifts the gold standard to an oil standard. And so you see all these changes happening simultaneously, which means that the relative value of corporations and of countries begins to change. And in that, there's a massive bear market where many stock exchanges, markets around the world lose as much as 40% of their value over the course of the 2 years. And again, this is the result of this movement, this implicit movement from the physical to the vital. Now in 1987, we see what's never happened before. We see a global synchronized crash of stock markets around the world where they shed their value very rapidly in a very short period of time. And this is the sign that we've now entered into a whole different level of operation. And further, that the notion of value, the deep intent behind value, has begun to change, because now value has taken on a different dimension, which is driven not by the local meaning behind things, but more by a global casino mentality. So it's a whole different notion of value that's coming into being, and this global casino mentality is very consistent with being at the vital level, where it's about irrational growth, assertive growth, growth that is just focused on developing a small notion of self rather than a comprehensive notion of self. And in 1990, with the Japanese asset bubble, what we're essentially seeing is that there's a contagion, or there's an integration of this way of being, this vital way of being, now encompassing more and more regions of the world. So from the West, it's now moving towards Japan, and then we see in the mid-1990s also the whole Southeast Asian crisis. And it's essentially